Please welcome the President of Tourism Economics, Adam Sachs.
Good afternoon, friends. It's so good to be with you. Congratulations on making it here. We get to delve into some of the key determinants of where our industry is headed. And I've chosen the road trip metaphor. And we're going to look at what indeed are a formidable set of engines, drivers of our industry, and indeed speed bumps for our industry. And I'm going to try to make sense of that and give you a view of how those two things are going to interplay over particularly the coming couple of years. Now, I should start by just setting a premise, which is that historically, if we can do a good job forecasting the US economy, we can do a good job at forecasting number of hotel rooms sold. In fact, if you look at the 20-year period that I've shown you here, the light blue bar line being hotel rooms sold and the dark blue being real GDP, you can see they move really, really closely together. Of course, you've got more volatility and downturns for the hotel industry, but they find each other again. So that's history. It doesn't tell us a whole lot about where we are now or where we're going. So let's approach it this way. We'll start by talking about what I would call a schizophrenic economy, with parts that are looking great and parts that are looking really, really tough. We'll go on to talk about what's going on in travel. How is travel responding to all of this kind of mixed bag of the economy? And indeed, I'll make a case for the resilience of travel, and then move on to a conclusion, which I believe is a set of really optimistic indicators that do give us, I think, a good sense for continued growth for our industry. So let's start here. We must start here and talk about the labor market, which is, we could choose a lot of adjectives, but I'm going to go with just absolutely anemic, right? You've got, in the month of February, a loss of 93,000 jobs. Take the full last 3 months, because February was probably not an indicator of where we're headed. You're looking at an average of just 6,000 jobs per month over the last 3 months. That is hardly a job-generating machine. But this is where we are within the history of the US economy. And in fact, if you just look at the last 4 years, you can see this step down in the average number of jobs that are generated per month in each of those years. And indeed, in 2025, only 46,000 jobs were generated each month. We think it's going to be weaker still in 2026, just 40,000 jobs per month. What is 40,000 jobs per month in context? It's about a fifth of the average over the last 7 years. Why? Why is the US economy generating so few jobs? Well, I think we can identify 3 reasons. One is that there was, post-COVID, overhiring. 2, there is, right now, evidence of strong productivity growth. That is the ability to produce more with fewer human resources. And then, of course, a slowdown in net migration. And so what we're seeing, and this is not career advice for anyone, but what we are seeing is that people are hanging on to their jobs. If you look at quit rates right now, they are lower, and quite a bit lower, than where they were pre-pandemic. People are holding on to their jobs. And so you have less churn in the marketplace. And that is one of the reasons that the unemployment rate has stayed really in a good place. 4.4%, it's ticked up to be certain. But you have this sort of, yes, there's a slow hiring environment, but there's also a slow firing environment and people not leaving their jobs. I mentioned migration. Let me put a bit of a sharper point on that. If you look at inflows of unauthorized migration into the US, you could see this massive drop that's taken place over the past year, right? And it was trending down already, but now we are at historic lows, at least within the last 6 years. At the same time, deportations have spiked. As a result, you've got a net 400,000 unauthorized migrants leaving the country each year. That's sort of the net result of these two charts. Now, there's still in-migration, but that in-migration is just about 100,000 more than this negative 1,000, so negative 400,000. So you're up about 100,000 jobs, 100,000 in the labor force each year now in terms of migration. And so that does put a bit of a cap on the size of the labor force, which of course is going to affect what happens with the unemployment rate. Now, I mentioned schizophrenia. That's another way to get at what I think is going to define a lot of what we're dealing with right now. Now, economists, we take a lot of heat for a lot of things. One of the things that you cannot say about us is that we don't know our alphabet. We're actually quite conversant in the alphabet. And the K is probably the most innovative of them, where we talk about parts of the economy that are doing quite well, that are going up, if you will, and then parts that are indeed going down. And what I'm going to do is, I'm not going to stand like this indefinitely, but what I am going to do is talk about each of those parts of the letter and how I think that is going to define where the hotel industry heads in the coming year. First of all, let's talk about mood. How are people feeling? Well, if you are in the upper third of income earners, you're feeling, well, better over the past year. But if you are, okay, I'll put down here, but if you are in the lower third, you can see how sentiment has plummeted in recent months. And indeed, that is one lens on which we see this K, upper income feeling good, lower income feeling bad. And it is absolutely flowing through to behavior. And in fact, if you look at how much consumers are spending on discretionary goods, and hotel stays fall within that category of discretionary goods, that middle 60% of income earners, their share of consumption going to discretionary goods has fallen steadily over the last 6 years, but particularly over the last 6 months. Meanwhile, that upper group of income earners, the top 20%, have actually shown real strength in the share of their income going toward discretionary goods, including hotels. It's not going to get better in the near term. If you look at what's happening with gas prices, the war in Iran is going to add at least, we think, a third of a percentage point to inflation in March through higher gas prices alone. And what you probably know is that affects different parts of the economy differently. And we're seeing it affecting lower income households. We're also seeing it affect younger people within the economy. And if you look at the unemployment rate by age group, you can see that the unemployment rate is the highest among 16 to 19-year-olds, next 20 to 24-year-olds, much higher than the overall economy. But if there's an upside to this, is that families are staying together. The share of adults age 22 to 28 staying with their families has gone to a new high. I know, I have one. And so maybe this is a silver lining, depending on the day. Now, there are also generational differences in terms of this K dynamic, and I do want to just give a shout out to the millennials here. Look, we were all worried about you. I'm not going to lie. But you're doing really well. And, notwithstanding the participation trophies that you may have received in your lifetime, in real life, you're actually accomplishing great things. Great job, millennials. What I'm showing you here is that your wealth accumulation at this age of your early 40s is well higher than the boomers and well higher than us Xers. So in that sense, millennials are ahead of, well, some prognosticators' expectations. Another element of sort of the bottom part of the K is the manufacturing sector. And manufacturing has now been shedding jobs for, well, the better part of 2.5 years. We are seeing signs of life in manufacturing, though. New orders have begun to tick up in manufacturing. So all is not lost within the manufacturing sector. I've lost connection. Go to the next slide. So let's ask the question, why? Why is this happening? Why are we seeing this divergence in parts of the economy doing really well and parts doing not so well? I mean, I think if we go to the next slide, one of the reasons, of course, is wealth accumulation. And wealth accumulation in the top 1% has increased just over the last year, some nearly 80%. And the top 20%, 80 to 99th percentile, 35% increase in net worth over the past year. So it's not surprising that we're seeing this resilience in consumer behavior among these groups. And one of the reasons we're seeing the downside in the lower income households is because of tariffs. And tariffs do absolutely hit lower income households harder. They're more exposed to the price increases that are flowing through to goods and services as a result of tariffs, because a greater share of their spending goes to those things. And so now with tariffs at an average of 12% across all of our trading partners, this is a significant shift in economic policy. Before April of 2025, we were looking at an average tariff rate of about 2%. And this favors upper income households in another way, which is that if you take fiscal policy and you net out the effects of tariffs, you can see that that overall effect of policy is sharply positive for upper income households. So this is the net income effect of those two sides of the coin. You've got tariffs, which frankly hurt everybody, and you've got the one big beautiful bill and its tax structure, which does particularly favor upper income households. So you take those two things together and you can see that it's not quite as terrible as you might think, actually, because anybody that's in the 40th percentile of income earners up is going to be on the net positive side of these two fiscal factors. Right? And it's interesting as you start to listen to what, and I'm going to share a number of airline quotes so you have a perspective from the transportation side. United just recently said for the year, looking back, it was premium revenues that increased 11%, while basic economy was actually down. So how is travel responding to all this? Well, if you were looking closely at the first chart I showed you, where GDP and room demand were moving right lockstep with each other, you would have noticed that I stopped the chart in 2019. I stopped it before the pandemic. Well, here's the rest of the chart, starting in 2018, but moving forward through the present time. And you can see as that relationship has actually broken. In fact, GDP is up 15% since 2019. Hotel room nights, according to STR, are down 1.3% over the same period of time. They have absolutely gone and taken a divergent path. What is going on? Well, I think we get a pretty easy answer here, because if you add in hotel room nights, cruise passenger nights, and vacation rentals, it's just about keeping up with GDP. So there's a different mix in overnight stays, but the relationship still holds. Now, some of the ways we're seeing breaks is, look at the last year from STR. Transient demand, rooms sold up 1.4%, while group down 2%. We're seeing it in chain scales, which, while there was a V right out of the pandemic, they've really, the chain scales are really taking their roles in the K-shaped economy with upper upscale and upscale, luxury and upper upscale, showing strong growth, continued, while the mid-scale economy and independents continued to struggle to get additional room demand. All right. Here's another area that I want to point out where we're seeing marked weakness. And it's in contrast to a domestic market that we'll talk about as being incredibly resilient, but that's international travel to the U.S. International travel to the U.S. took a sharp turn downward this past year. We saw it in March, even with the shift in Easter, showing an increase in April. Overall, overseas travel to the U.S. fell every single month of the year, effectively, starting in the spring. For the year, overseas falling 2.5%. If you include Canada and Mexico, travel to the U.S. fell 5.7%. In some ways, you might say that's not all that terrible, given all the headwinds there. But we would say that we've lost opportunity here. We've lost opportunity because a year ago, we were expecting international travel to grow about 9% and make its way toward 2019 levels. As it stands, international travel to the U.S. is down still about 14% relative to 2019. So this was a drag on hotel room demand last year of about 0.5 percentage point. Right, so that means that were it not for international falling last year, room demand, instead of being down about 0.4%, would have been slightly up in the U.S. So it is a significant factor. There's kind of fascinating dynamics across international markets. Among the top 20 overseas travel markets to the U.S., we see about as many showing growth last year as declining, but nevertheless, the overall effect was a decline, and it's absolutely traceable to divisive policy and divisive rhetoric out of the White House. And we've seen it nowhere more acutely than from Canada. Canadian travel to the U.S. fell 25% last year. Apparently, Canada does not want to be the 51st state, and they are letting us know. Right? And at the same time, Canadian travel to the rest of the world increased 8%. So the U.S. is losing market share at a pretty dramatic clip right now. All right. Meanwhile, hotel demand within Canada increased 1.2%. A lot of that, what in Canada is becoming a reshoring of international outbound travel toward domestic travel in Canada. An interesting dynamic that happened as a result of that plummet in Canadian travel to the U.S. is that Mexican travel to the U.S. held up and, in fact, increased 8% last year. And so for the first time in recent history, there were more Mexican travelers to the U.S. than Canadian travelers. So with all of that said, I want to make a case for optimism. And I'm doing that not just because I'm prone to that. I'm doing that because I want you to come away with a direction. Not oblivious to risks, but a sense of direction here. And there are a number of reasons that I think the sense of direction we should have is that of strengthening of our industry. One of them, and I've mentioned this already, but I want to get into a bit more detail on the effects of the One Big Beautiful Bill as we move into the next couple of years. And I've been, I think, rightly critical of tariffs, and there are reasons to be critical of this bill, I suppose, if you think about national debt. But if you think about the growth that we should expect in the U.S. economy, this is pro-growth. Because if you factor in the Tax Cuts and Jobs Act extensions, investment incentives, and spending on defense and border security, those things are going to boost GDP by about 0.5 percentage point over the next couple of years. And so, yes, there are negatives, things like the effects of immigration cutbacks, cuts to social benefits. But overall, this is a pro-growth package. And so it's not surprising to me, and it's entirely consistent with that we're seeing corporate travel grow. And American Airlines pointed this out recently, that their managed corporate revenue was up 12% in 2025 and is strengthening further as they look forward into 2026. Another reason for some optimism is that for one of the massive headwinds that we've had over the last several years has been inflation, right? It's forced the Federal Reserve to raise interest rates, to slow down the economy and prevent runaway inflation. Well, we are in a position where, provided that we don't see a protracted conflict in the Middle East and an expanding conflict in the Middle East, where prices will continue to moderate, where we will see the rate of inflation continue to come down through the latter part of this year. One of the reasons why that is very, very likely is because we're going to see the effects of tariffs roll over. Right? So they will be baked into last year's numbers in the latter part of 2025. So as we get to 2026, you won't see that additional increase in prices. We also see the effects of housing and the CPI coming down. And so these things lead us to believe that we're going to see consumer price index moderate over the coming year, year and a half. The implications of that are not only good for consumer spending, but also good for interest rates. We should see 2 more interest rate cuts from the Federal Reserve in 2026 as this happens in the background. And fundamentally, for all the things that we might be concerned about, wages are still growing at a pace well above the rate of inflation. So earnings are growing at around 4.2%, with inflation around 2.6%. That means that real incomes are rising. And as real incomes rise, we do have more discretionary income for things like travel. And then on the business investment side, we're also seeing, I think, some glimmers of hope and glimmers of life. And so much of business investment has been driven toward technology and AI and data centers over the past 18 months. What we're seeing now is the beginnings of a broadening out of investment behavior by businesses. That is going to be another boost to the U.S. economy. We're seeing that as a result of less policy uncertainty because tariffs are not in the state of flux that they were in through most of 2025, going up and down by double digits on any given day. We're seeing the benefits of tax incentives in the One Big Beautiful Bill, and then the effects of lower borrowing costs with continued cuts to interest rates. So all those things mean that businesses are going to continue to invest, and we think invest even more broadly in the U.S. economy as we move through the back half of 2026 and into 2027. Now, there was an interesting piece of research that the Financial Times published recently that I thought was striking because they looked at the effects of AI on real per capita GDP. And they ran, these researchers, professors of course, ran different scenarios. And the upside was remarkable. The upside was that real GDP per capita will go up from around $30,000 to $500,000 because tech singularity is achieved. All of our needs and wants are provided by our benevolent overlords. We'll call this the WALL-E scenario, right? But wait, the researchers were not done. They said this is not the only possibility. There's also the possibility that the machines say, you know what, we're going to take it from here. You've had a good run, and as a result, real per capita GDP plummets. And here we'll call this the Terminator scenario. We Oxford Economics think both of these outcomes are vanishingly unlikely. And the middle range is really unexciting, but I think the most likely one, which is that we see a boost to GDP of around 0.25 percentage point per year over the coming years. And so let's go with that. Let's go with that as our baseline for planning. And that will, I don't want to discount it because it will absolutely produce a tailwind to economic growth in the coming years. And if you look at AI adoption by industry, you can see where we are by different industries. information, not surprisingly, some 40%, but over the next 6 months, we're going to see another 7-8% added to that in terms of the percentage of firms using AI. But overall, you're seeing some 20% of companies actively using AI, and that will continue to increase. It will continue to produce efficiencies and productivity gains in the U.S. economy. And so what about the workforce? Are we going to, is the white-collar workforce doomed? I think that also is overblown. And if you look at what's going on just in the recent history as an indication, there's no sign. There's, even with some of the headlines of AI-related cutbacks in workforce, there's no sign of that cutback right now. This is jobless claims, monthly data. And look at initial jobless claims, that's the red line. That's actually just fallen consistently in recent months, as well as continuing jobless claims. And so I think that gives us a bit of a floor to what's going on in the labor force. So even if there are only 40,000 jobs added per month over the coming year, that should be enough to contain the unemployment rate certainly below 5% as we go through this year. And so what that means, big picture, the U.S. economy is going to pick up as we move through this year. We're looking at from just 2.1% growth in 2025 to 2.8% in 2026. What's behind that? Yes, it's fiscal stimulus. It's the tax refunds that are going to be about 20% higher than they have been historically as those are received in the coming months. It's those business investment incentives that we talked about, and consumer spending supported by the income growth that we talked about, and that wealth accumulation. There's another dynamic that I think is really important, and another reason for my underlying optimism, and it is that there has been a shift, and I believe an irrevocable shift, from goods to experiences. And if you look at real consumer spending by category, look at what's happened over the past year for spending on recreational goods, services, restaurants, and hotels compared to everything else. And it is that prioritization that Delta pointed out. The U.S. economy remains on firm footing. Consumers continue to prioritize experiences, with travel among top spending categories. And let me make a case for why the K-shaped economy, why the hotel industry can do more than survive, but indeed thrive within a K-shaped economy. Because if you look at the spending by households on hotels, and look at how it indexes across different income categories, you'll see that for those making $150,000 or more than half of consumer spending on hotels is within that group. And so it's not surprising United said premium revenues continue to lead the way, while standard main cabin seats continue to show some weakness. And we as an industry are certainly over-indexed to these upper-income households, and these are the ones that are in the strongest position moving forward. If you take everyone earning $100,000 and more, that represents 70% of all spending on hotels. And this is a dynamic that we see continuing moving forward. Look at the trend on the share of spending among high-income households in hotels. So the high income, $200,000 or more, now represent over a third of all spending at hotels, up from 25% in 2018. And now there are 2.3 times as many households with income over $200,000 as there were in 2018. So our base of customers is growing. And sentiment does seem to be not only resilient, but continuing to favor travel. This is from our friends at Future Partners, who run a monthly survey of U.S. households on their travel intentions. And they found in their latest data that just came out last week a record high. And as long as they've been running this survey, 93% of respondents said that they have leisure travel plans over the next 12 months. And when they ask how much budget have you set aside over the next 12 months for those trips, again, a record high in the latest reading of some $6,500 $558. And so we're not seeing a pullback. We're not seeing worries translate into travel behavior. Add to that, as concerning as international travel patterns have been over the past year, we do think that 2026 is going to mark a turn. And so despite the significant declines of 2025, we should see an increase, particularly with the World Cup this summer. Overall, about a 3.7% increase. Now, that doesn't get us back what we lost in 2025. It still keeps us, double digits behind where we were in 2019. But it's an important shift because international will no longer be that 0.5% drag on room demand that it was in 2025. It's going to start being a net positive in 2026 and beyond. And so big picture, again, we see travel positioned to grow modestly, but also broadly, because international shifts from negative positive, the U.S. economy begins to accelerate, and therefore hotel room demand shifts from slightly negative to, we will say, slightly positive in 2026. And you see this from the airlines, business travel showing signs of improvement as corporate confidence grows, and bookings and yields outpacing the strong start from 2025. So there's a bit of a tailwind that we're seeing right now in travel. And here you have a picture of the STR Tourism Economics forecast in summary. And after 2025, where occupancy rates fell by 1.2%, not quite exceeding the increase in ADR of about 0.9%, RevPAR we do expect to turn positive in 2026, with ADR growing 1% and overall 0.6% RevPAR growth in 2026. And so let me try to just give you this in one page. These are the two categories, what they call it, engines and speed pumps, the two parts of the K in real time. On the policy front, there are some things that we think are going to drive us forward. Right? We see interest rate relief, investment incentives, and tax cut extensions. But policy is not all good. The tariffs continue to be a drag on U.S. economic activity. Immigration cutbacks will overall be a net negative for U.S. economic growth. And then, of course, geopolitical uncertainty, particularly in the Middle East, looms large over all of this. On the broader economy, we do see real income growth that's continued to outpace inflation. Strong balance sheets, especially among hotel customers. Productivity gains influenced in no small part by the adoption of AI. But on the downside, we see particular weakness among small firms and a softening labor market that's going to limit job growth in the coming years. But then on the travel front, encouraging signs. The prioritization of travel and experiences that we see as an ongoing dynamic. The K-shaped economy, which favors our customers and their desire and willingness to spend on travel. Business travel confidence that we've talked about. And then, of course, upcoming events, in the World Cup in particular, and the turnaround, slow as it may be, for international travel. Travel sentiment for international markets will continue to be strained. I don't think that we can say that international travel is going to come back in droves because of that negative sentiment toward the U.S. right now, and of course fuel prices. But overall, the prevailing effect is that we do see the balance of these engines and speed bumps mean that we are going to get over these bumps and continue to experience growth in the coming years. Thank you so much for having me with you. Really a pleasure.